What's up, everybody? Michael Silva here to do some technical analysis on the financial markets. September just came to a close. Our quarter just came to a close. So today's video is going to be a little bit different than usual. I'm going to be kind of just giving you my idea as to where I believe prices are going and why I've been a little bit more hesitant than usual believing this rally. So we're going to start off by looking at the quarterly chart. We're going to just take a peek at the yearly chart, and then we're going to hop into some lower time frames. But then I'm also going to talk about some of the different sectors as well, bringing a couple new charts into the mix. Let's go ahead and hop into today's episode. All right, welcome back. The first thing that I want to do is start off on the quarterly time frame for the SPY. And if you follow me on Twitter, you probably saw me post this. If you didn't, follow me on Twitter. I post a lot there intraday. I'm going to start posting more on Instagram too as well. I'm kind of working out the kinks for all of this stuff. I've been very busy, from work as well. So we'll figure that out in the time being. But on Twitter, I posted this. This area of resistance right here, 339.38, was very important for the bulls to actually overtake for the quarter, and they could not do so. This looks like somewhat of an inverted hammer. This long lower wick right here, gives me a little bit of a, kind of upset stomach a little bit, thinking that, hey, this could potentially start pulling back. It shows that a lot of bears stepped up right in this area. It shows that a lot of buyers are trapped up here, and that we closed below this resistance says that the bears made a little bit of momentum today. So it's going to be interesting to see how the quarterly chart does play out. Now, this is obviously, every single candle here represents 3 months of data, so it takes a long time to build up. But if you take a look down at the RSI right here, look, it was way overbought over here, and then you can see it sloping down throughout here. That is clearly a negative divergence. We have the RSI going down, making a lower high, and yet we have the price action making a higher high into an area of resistance, and it didn't quite close above there. It has a long upper wick. So if I don't have the Bollinger Bands on here, but the Bollinger Bands, it did get overextended into the Bollinger Bands, and it was right around this point right here, 339.38, so it closed just below the upper Bollinger Band too. So there's a lot of confluence in that area for, resistance. We are disconnected as of right now to the 5 EMA, the exponential moving average, so that can very well start to push down to reconnect with it. It's a very big possibility. However, you got to look at the context of the chart here. The context of the chart is bullish. We have all the moving averages sloping up nicely. The price action is sloping up nicely. So, that's good for the bulls. For the bears, though, like I said, we have some overextensions, a lot of confluence up ahead. And then, if you look at this big pullback here on big volume, and then this uptick here the last couple of quarters happened to be so on a lot lower volume than usual seen in the past here. So that's a little bit of a cause for concern. This is the yearly chart, and you're probably wondering, why are you looking at a yearly chart? There's really no reason I really look at a yearly chart other than this just gigantic spinning top type candle right here, and clearly just the amount of volatility this year from a low 220 to a high of 358. And if you look back at the history of the chart, clearly there's just significant more volume this year than any other trading year, and this is dating back all the way to 1996 back here, even before. So it's just a lot of volatility, and this upwards move with this type of candle, that's not always a good sign right there. Not at all. And we're very far disconnected too from the 5 EMA going into the month of October during a presidential election as well. So it's very possible that if we do get that pullback in October, which we've seen previously, we can retag this 5 EMA. It's very possible. Now, keep in mind, there's a lot of talk still about stimulus. There was talk today about stimulus. It was good news at the beginning of the day, bad news at the end of the day, and you could see that the market reacts. So if the market is showing us reacting with no stimulus, chances are if there is stimulus that comes out eventually, the market can react pretty positively. But we're going to look in the lower time frames to see where the market can actually go to get ideas of price targets and or short position entries. Now, before I get into those lower time frames, I want to talk about 3 things in particularly. I want to talk about first these sectors right here. This is the S&P 500 sectors, and we're going to look at it on the monthly column right there on the right. or your left. I don't know where it's going to show up. I think they're right. And then we're going to look at the treasuries, and then we're going to look at the dollar. So first, starting with this and why we're looking at those things is because those are typically risk off sort of assets. When investors go into treasuries, they go there for a safe haven. So when you see a rise in treasuries, that typically means that something is taking place behind the scenes. It could be a very, very possible an early indicator. Now, in 2020, that hasn't been really the case. We've been kind of pinned going sideways for most of the year, but we'll get into that here shortly. And then the utility sector, which we're about to talk. If you just look at the sectors and the monthly section right here, I mean, just look at the performance for the month. This is the month of September. Energy, way down here, down 15%. The two performing industries is utilities and materials. Now, you've got to ask yourself, why would utilities be performing? Utilities are typically lower beta, and why would investors go into lower beta assets? Typically, lower beta assets would be a place that investors go to reduce risk in other different assets. And utilities such as electricity and water, which is what makes up the utility sector, are necessities in the economy. So people tend to move towards necessities in the economy for their investments to protect their wealth. So that's one thing. And you could see here on the monthly preference, this was one of the only positive sectors for the month of September. So that signals to me that this is a very possible shift in momentum, shift in change taking place in investor sentiment. It's saying, hey, we're trying to take some risk off the table and we're trying to get a little bit more safe. So that's the utility sector. I want to show you a chart with the utility sector compared to the SPY. So I'm looking at basically a ratio chart, and I'll walk you through why it's important. So here is the XLU, which is a utility select sector. Okay, it's a spider fund, and it's over the S&P 500, the SPY. And really quick, when you see it go up, when the ratio goes up, that means that utilities are overperforming the SPY. So what have I just said? I just said that basically when you see an uptick here in the ratio, or when people move into utilities, it's typically to remove risk off the table. So look back here in early 2020 in January. You started seeing the XLU to SPY ratio kind of spike up, right? You saw it from down here, and you saw it spike up. So right around this area, it looked like investors were moving in to less risky assets. And if you look down here, this is the SPX, and they started moving to those utilities and seeing the uptick here right before the big sell-off here in March. You can look back at 2018, the end of 2018 right here. And you saw investors starting to push more into utilities. Right here, you saw this big run-up. Well, what happened at the end of 2018? We saw a big downdraft. We saw it from, up here at I think that's 2,900 to 3,000, all the way down to about 2,500. So a big drop off right there. So this just kind of goes to the narrative that investors go into safe assets if they are concerned about the overall economy, or if they believe it's going to deteriorate over time. Why is this important now? Well, it's important now because just here in just late August, we started seeing an uptick here in utilities. And this blue line right here is the 13-period weekly moving average. We're looking at a weekly chart here, and we're starting to see a big uptick. So from the end of August to now, the end of September, we're moving into the end of September, right? Going into October, people are starting to push into utilities. Now, this is obviously coming from a big downdraft, so it has a lot of room to make up on this ratio. But if we start seeing this continue to the upside, if we start seeing it cross above this 13-period weekly moving average, that could very well result in some sort of trend shift here. And we've already seen the SPX take a nosedive from around 7 to 10% this month, and we're seeing a little bit of an uptick right now, but this could be very temporary. So that's one thing that I want you guys to consider here, why I believe that you got to be very cautious in this environment, okay? Yes, a stimulus package could come out. A lot of people say it's not going to happen. A lot of people think it's going to happen. I don't really care, but what I do care about is being prepared in the case that it does come out, right? Or if it doesn't come out, I should say as well. This game is all about protecting your downside risk. If you're good at really protecting your downside risk, you can make money over time anyway. It's just as simple as that, but it's also as complex as that. So that's the utilities sector, okay? People are running into utilities, that's a safe haven. Let's look at treasuries. So here is the 10-year treasury chart, and I'm going to show you this, but then I'm going to show you some ratios. Today, we saw quite an aggressive day comparatively to the last, couple of weeks, really. Maybe not a couple of weeks, but 1, 2, 3, 4, 5, 6, 7 different trading days. And today's trading day outweighed all of those in terms of volatility, from the low all the way to past the high. As you can see here, we went from open here, close here, but we went as high as over here. So we're still trending sideways, still above the 50, but up almost 5% for the day going into the end of the month. So we're going into October, and we're ending the quarter, and we're seeing investors step into the 10-year. I don't know what to make of it quite yet, but what it's telling me right now is, we have a little bit of a run into safety right now. And, it's going to be interesting to see where this goes. I said that I was short-term bullish on this breakout. It looked like a breakout, but then it started getting a little weak. So, I'm going to be keeping an eye on it. Close below the 50 period. That's 6.46, yield of 6.46. That can very well send us lower. But as I see it right now, up 5% in a day is, a big move, for coming into the end of the month and into October. So this could be the start of something bigger. But let me show you another chart. So I just showed you the 10-year, but let me show you the 10 to 20-year Treasury bond ETF over the SPDR, okay, over the SPY. And this is one of those charts also. When the chart goes up, it means investors, the sentiment is shifting from basically wanting to take more risk in equities to, hey, let's protect ourselves. So the higher it goes, it means that investors are protecting themselves. The lower it goes, it means they're taking on more risk. Okay, treasuries aren't, typically insanely volatile. So what do we see happening here? Well, here in early February, somewhat right before this drop off, we crossed above this 13-week weekly EMA, and then we saw this huge spike up. Okay, people went to safety. They flooded to safety. The market fell down. When the market reached down to 2,300, it was a shift in sentiment. They went from basically being risk off this entire run up to let's hop into equities and get on this, hop on this trade. And we saw it downdrift. What do we see going on right now? Well, we're seeing a little bit of an uptick. Okay, got rejected right here by the 13 weekly period EMA. I'm just going to call it EMA. But this could be a temporary pullback. We got up. We're seeing a little bit of pullback. We very well might see an uptick here. So this is something that we're going to have to watch, because this could very well mean that our sentiment is changing. Now, we don't know if, certain news is going to come out. And it's like the market reacts to all kinds of news right now. It could be something around debates, right? We talked about that in the last market brief. It could be something around stimulus or various other political topics. And then we have the vaccine and all this stuff going around COVID. So there's just so much news and so many things that are driving all this uncertainty in the economy. So what can we do? Well, we got to look at assets like these. When we see investors run into assets to protect their wealth, that could be the early indicator saying, hey, maybe I should do the same. Maybe I shouldn't be over leveraged on all these call options on these monster tech companies or all these other high beta stocks that could potentially see more risk than other various aspects in other various sectors. Okay, that's TLH. Excuse me, losing my voice here. That's the TLH if you want to look that up yourself. And all these charts are linked in the description below. Let me show you another one. Here is the TLH over IEF. So this is interesting. This is two different sets of ETFs about treasury bonds. Okay, long term over short term. We have 10 to 20 year over the 7 to 10 year. Why am I showing this chart? Okay, the reason why is because if people start moving in, or investors start moving into 10 to 20 year treasuries, it could just signal, longer term safety, at least in my head, over the shorter term. So we saw a big uptick right here. Boom. More investors moved into the 10 to 20 year over the 7 to 10 year. Now we're seeing a little bit of a downtick right here, getting rejected again by the 13 EMA. But if we start to see this move up, that can also tell us that investors are moving into longer term treasury bonds because they're seeking safety. So something to keep in mind. Now we are building lower highs, or sorry, higher lows. We got a low here, then a higher low here, and another higher low here. So, you know, keep an eye on this. If we start getting above this EMA, that could be very well, you know, a continuation of this move to the upside. The next chart that I want to discuss is the US dollar. Now, this is the chart that I've been saying, hey, we got to keep our eye on the US dollar. This is probably one of the more important ones, along with treasuries. Okay, so we got dollars and treasuries. Why is it important? Because it really helps us determine where the market might head next. If the dollar rises, could very well represent that people are seeking safety in cash, in the dollar, right? Well, we saw an uptick here. It was a breakout of a bull flag, breakout of this channel. We saw the uptick, and we saw equities drop in the month of September, okay? So here's September right here. We saw it move up, we saw it consolidate, we saw it move up higher. What did we see the S&P 500 do? Well, we saw the S&P 500 drop, we saw it bounce, we saw it form a falling wedge, and then we saw it on this downtick right here. We saw a little bit of a breakout of that falling wedge. And we'll get into those charts here shortly. But what you can expect here is if we see some strength pull up in the dollar, it's going to put pressure on high beta equities or the S&P 500. We're going to see equities markets start to kind of roll, at least my opinion. If we see it get up to 96, that could put a lot of pressure on the equities markets. Where do we get rejected? Well, this right here, it trapped a couple people. The little upper wick right here kind of came up. So you can call that a false breakout. And then we saw a rollback down. So if you look here, that was a 23.6 fib level. It bounces support right here. I mean, this is all technically correct. This is all making technical sense to me. Now, today's trading candle, this right here is a doji candle. What's a doji candle represent? A doji candle represents indecision. So we were getting rejected right here. We didn't hold 94, which was the level that I said, hey, I think that it needs to hold it. Could I be wrong? Absolutely. It's right there at 93.93, so it's close. Now in the currency markets, that could be a big difference, right? These small moves can make big differences, but clearly we had a lot of volatility this day. We swung all the way up, swung all the way down, met right back where we basically opened. And what is this telling me right now? Well, this could very well mean that I don't know if I want to head lower and I don't know if I want to head back higher. So we got this big pull and we transferred sideways. I can see people calling this a bull flag right here. I can see people calling these 3 days a falling wedge. So let's see what takes place here. But what I can assure you is if we start seeing a breakout of 94.64, you know, take risk out of these aggressive equity positions that you might be in right now, because that can apply, like I said, a lot of pressure. And where I see it right now, the trend of the dollar is bearish. The trade, however, it still is bullish, right? We're above the 50 period moving average. It hasn't been above the 50 period moving average in quite some time. You know, look at way back here. It closed, in mid-May, got below it and stayed below it. It's been a long time since we crossed above it, and now we did. And if you look at the history of the chart, when it did get above it, it bounced from it, it bounced from it, it bounced from it, it bounced from it. So it held as some sort of level of support. Now we're getting above it. Let's see if it can hold. We're going to have to watch this one. Like I said, it's an important chart to keep an eye on. Okay, so we just talked about the dollar, we talked about treasuries, and we also talked about the utilities. Do you understand the picture that I'm trying to paint right here? We've been talking about market uncertainty taking place. I've been saying that it seems uncertain. A lot of things are kind of flashing, all these weird signals saying, hey, maybe you want to just take it easy. So we've been taking it easy, all right? And now I'm looking at utilities, getting this up, outperforming the S&P 500 as one of the top sectors, and every other sector fell. So that seems to me like people are flighting into safety. You see treasuries, pretty aggressive day to day. They've been really tracking sideways, but on the other charts I showed you, they're looking like they're having some sort of strength right now. People are moving into safe havens, quote unquote safe havens, right? And then the dollar, we saw the dollar move an uptick as well. This looks like a nice basing pattern right here in the dollar so far. So can it crumble? I mean, yeah, there's so many different things that can make this dollar push even lower. So we're gonna have to watch it. So overall, my thought process is I'm kinda leaning more bearish right now than anything, but open for something bullish to take place. Like I already stated, any sort of news, positive news or perceived positive news. I should use that. That to me would I gotta be prepared for, because then I want to catch those movements to the upside. It would make sense too, right? I would imagine you agree with you want to catch that upside momentum too when it's available. Here's the S&P 500 on the monthly time frame. We just ended September. New candle ready to form. Look at this dark cloud variation right here. Or you can call this an outside trading candle too. It's not a full bearish engulfing, but it's called, dark cloud coverage. We had a matching open, and then we closed more than halfway through the body. But look at the wicks. We traded not only above it, but we've also traded way below it, retagging the 5 EMA. It's a frequently tagged moving average. We've discussed that. Okay, this doesn't, to me, look very bullish. It looks like it has a lot of work to do to continue to move in the upwards direction. To me, looking at this chart, just look at it. What if you showed this chart to a 5-year-old and you said, hey, look at it, goes up and then down and then up and then down and then up and then down and then up. Where do you think it could go next? They'll probably say, I think it could go down. And they'd be right. Look at this RSI. A high here to a lower high here. The price action. A low high here to a higher high here. Negative divergence. All right? This market can still go higher. It can. But like I said, you got to be ready for that type of news to hit, because as I see it, you got more companies talking about job losses and job cuts. Disney just the other day announced it. I forget where else, but I'm sure you can Google it and find out. It's somewhere out there. Some energy jobs. I can't remember, but Disney was one of the bigger ones that I can't remember. So the overall economy is struggling. Investors are moving into safe havens. We've already pointed that out. Maybe I'm just feeding the narrative as to what I kind of believe right now. But, and if that's the case, if you actually believe that, tell me, I guess, what do you think could change my mind? Let me know what is bullish going on right now, and dig into that a little bit, because I would like to know. Because this market, like I said, it can go higher. But as I see it, there's more ideals in the bears' favor than there are in the bulls right now. That's just what I'm reading. Here's the daily time frame. We've been keeping an eye on this, right? The falling wedge, we broke out, looked good. We said that there's going to be resistance right around here at 61.8. I don't know if I said this or I was thinking it. I'm pretty sure I said it, but I don't see why I couldn't get up here and then have some trouble. But also I would think they would get up there with better news around the whole stimulus thing. So where did we finish? Well, we finished above the 50 period moving average. So that's a good sign. We finished above there for the week. But in the last 3 trading days, we've been just going sideways, and, we're disconnected from the 5 EMA. So it's very possible we might go reconnect with that. And this candle, I don't like. This candle came all the way up to the 50% retracement level and got rejected. That is, on an up move. So this right here, to me, it just doesn't look good at all. It looks like just an inverted hammer. So, we'll track it. We'll see what goes on. But, this could still go up higher, and then all of a sudden see some momentum to the downside. We're going into October, right? We'll see. Our first target was hit. We had the box right here. I still think it's very possible that we come into this range. I don't know exactly when, but when we start seeing this round off, or if we start seeing this round off, I'm going to start showing you guys this head and shoulders pattern that I've been kind of keeping an eye on, but I haven't really talked too much about it all. But it's there. It exists. Speaking of head and shoulders, here's the VIX on the daily time frame. And you could actually really see this on the 2-hour time frame a lot better, but I'll just draw it out on, the daily. What do we got going on? Well, we had these falling wedges, boom, broke out, falling wedge, boom, took to the upside. And now we're seeing, well, this was a falling wedge, right? It's kind of fell into here. But what I'm drawing out here is an inverse head and shoulders. Very interestingly today, we had an up day in the S&P 500. We had an up day today in the VIX. Take note. Interesting. We're still tagged between the 50 and the 200 period moving averages right now. And we're kind of basing out. This right here is very possible to be an inverse head and shoulders, where if we break, 34, that would make sense. 34. Yeah, I would say 34. That could very well send this thing higher, back up into our target range where we were saying 45 to 50 or 40 to 45 or wherever we were saying. But that would make sense on this chart. And if we see that spike up, we're going to see the S&P 500 nosedive. We're going to see it move down fairly quickly and aggressively when volatility picks up like that. I don't know if we're going to fill this gap here. That's been bugging me. Everyone knows that's been watching my channel. They know that I hate this gap down here because the gaps typically fill, and they haven't filled. So I don't know. Maybe the shoulder dips lower. Maybe we do see continuation to the upside, but I'll be patient with that one. Here's the Nasdaq on the monthly time frame. I showed you this chart previously, so if you're new here, this chart's pretty crazy, right? The monthly time frame just ended. This is a dark cloud coverage candle, very volatile trading day, but it's following up from just 1, 2, 3, 4, 5, just literally rocket ship months up into the stratosphere here. The RSI indicator, it's overbought. When things are overbought, they can be there for a while. We've seen it overbought for quite some time previously, okay? However, look at the high here. sloping down to a lower high here on the RSI. Look at the price action. Low high to a higher high. That's a negative divergence. Does that mean that, this RSI can't go higher? No, it doesn't mean that. But, take note. This dark cloud coverage that's on this big move to the upside, take note. That is bearish. And then you can look back here. From late 2015 to 2016, we pulled back to this blue trend line. This was an aggressive move. That was down 18%. Here in 2018, we've talked about it. Remember when we were talking earlier about people moving into treasury bonds, getting risk off? Well, 23% decline in the equities market here. NASDAQ 100 we're looking at. Boom, 23% to this trend line. And we saw a nice run up. That's Coco. And then we saw a 30% drop here in March. Boom, right to the trend line, perfectly. If we see this drop happen, sharp or whatever the case may be, we have a couple fib levels down here. We have the 50% retracement level. I can see a retracement of 50% happening. But if we see a 50% retracement, gosh, that would just do damage. It would be absolute devastation. We're talking I don't even want to really honestly picture that. I don't even know if the Federal Reserve, Congress, whatever, would even allow something like that to take place because of just what that can do to an economy when we have the largest demographics coming into retirement, the baby boomers. Imagine going into retirement, working your entire life, and getting chopped at the knees, heading into, retirement. You tell me what happens when that takes place. Not to mention with all these jobs that we're losing. It's very scary to think about, but it's very realistic. This is realistic. This could very well happen. So we got to be careful and monitor our risk. And I would imagine that people that are coming into retirement aren't just over leveraged in, high beta equities. I'm sure that they're in a lot more, protected, type investments. I would hope. I would hope so. And if you don't know, maybe you should talk to a fiduciary. A fiduciary, is not trying to sell you on anything. They're trying to do what's best for your current financial conditions. Probably costs money to talk to a fiduciary, but probably well worth it, especially if your net worth exceeds, a few $100,000. It's definitely worth it, at least to get input for a couple of $1,000s by a professional. I mean, why not? Here's the NASDAQ 100 on the daily time frame. I'm gonna leave that in there, okay? Well, this doesn't look too bearish right now. I mean, a little bit of I don't know what that candle's called. Spinning top. We had a gap up, close the gap, kind of mid-sized body with wicks on both sides. Retouch the 5 EMA. I think that's a spinning top. That potentially could very well mean that we're headed lower. But as I see it right now, we gapped up, closed the gap, moved a little bit higher. Pretty strong day so far, but we ran into some resistance on the high at 11,535. And that makes sense because if you look back in the history right here, 11,600, you had a wick stop here, a wick stop here, an upper wick here, an upper wick here. So overall, we broke down through this up channel. Boom. We might have a technical retest. That's normal, right? You can see these retests take place, and we very well might go get a retest. Now, a couple levels to look out for, right? If we get a continuation to the downside, if we start closing below this previous green candle, I think the 38.2 fib level is going to be extremely important. So we're going to watch that. But as I see it right here, if we can get above 11,600, why couldn't we go retest this lower trend line right here, part of this channel? That makes technical sense to me. But, like I said, we'll see. We will see. The MACD crossed back over, trending sideways right now, way above zero. But this could be the start of a bearish type trend. Here's the NASDAQ 100 on the daily time frame. We mapped out this channel that we broke out of. You could call it also, we said it was a falling wedge. Very similar. You got the MACD crossing over, kind of looks nice. Everything looks fine. We're disconnected from the 5 EMA, but it's overcrossing the 50. We recaptured the 50, so it looks good overall. But if you look at this candle, long upper wick, smaller body, this could very well be an inverted hammer. Could start heading lower. But like I said previously on the weekly chart, if we break above that 11,600 level, which is right here, we see some prior resistance. Yeah, why can't we go higher? What I see taking place right now is a contraction in the Bollinger Bands. You see the upper Bollinger Band was way up here, and then it just went woof, sloped right down to here. We see this bottom lower Bollinger Band from down here, shoo, sloping up. That's going to be contracting, and that makes sense because of the volatility that we've been seeing. It expanded. This deviation or standard deviation, whatever we call it. Okay, so if we start moving up and this keeps contracting, that's going to add another level of potential resistance, which means we would have more confluence, for the bulls to try to get through. The NYMO is an important indicator as well. This is just to get a good idea of sentiment in the market. It's the breadth sentiment indicator, if you want to call it that. And really, on yesterday's thumbnail, I was talking about how the market made a new high, but on a negative breadth. And I don't have back to 2018 right here or right now, but a very similar thing took place in 2018 where the market made a new high towards, the mid 2018 going into, it was mid 2018, made a new high on the NYMO being a negative breadth. And then what did we see? We saw it jolt to the downside, then we saw a bounce, and then we saw a continuation to the downside. During that time, we saw the NYMO, negative breadth, go into positive territory for a short period of time, but then boom, made to another low, which really started bringing that down. And we're seeing something very similar here in the SPX. Okay, made a new high, negative breadth, pulled down on the falling wedge, boom, we saw the uptick. A couple little different bounces here. Boom, we saw a continuation to the downside. We haven't actually got the NYMO to really get positive yet. If we start seeing the market move higher here, we might very well be seeing something similar that took place in 2018 where we do see another leg lower. So, I don't know. Watch out for that. Here is the Pring bottom fisher indicator, and this helps us to find market bottoms. Now, it's pretty darn accurate for finding market bottoms, give or take some ranges though. And what I'm seeing right now, we're seeing a bounce right here from this level. And when you look at the Pring indicator, we're below this 10 line. So that means, okay, now we can start paying attention. When the blue line crosses over the green and they both start sloping up, that can very well indicate, okay, the market's finding, its legs. It's kind of coming from the bottom. And if you look back here, we saw that here in March, okay, a little bit later in March. Right here, we saw some big downward pulls and then we saw the move up. This helps find bottoms. It doesn't find exit points. It doesn't find, entry points. It just kind of gives you a good idea as to when the market might start turning to the upside. And as I see it right now, it's sloping down. So you don't need to put all this weight onto this one indicator, but it's a well-known indicator. It's good to use to find bottoms. Why not use the tools that are in our tool belt? Another cause for concern that's been in the back of my head is the banking index. This is the KBW, the largest U.S. institutions, 24, 25 of them, I can't remember the number, broke out of this symmetrical triangle. That's bearish. We broke out. Now we're kind of seeing a little bit of an uptick. That makes sense. We got disconnected from the 5 EMA and we're running back into it. Now we're going to be tracking this as time progresses because this could be the very start of something potentially bigger to the downside. A lot of banking stocks and the financials, they look weak and they've been weak. So this breakdown right here, we might get this back test. We'll see if we can get back into this section here trading. But overall, bearish context, bearish trade, things tell me stay away from the banks for right now until we get some, change of direction or see some bullish type trades. This is on the weekly time frame. Same thing goes for the KRE. This is the regional banks. This has a good sense as, the mom and pop banks. This kind of has a good grasp on where our economy is because they represent the economy, okay? These are the smaller banks. These aren't these monster U.S. institutions. But very similar pattern, right? We broke down through the symmetrical triangle. MACD looks like it's starting to cross over. We're getting a technical retest here that can continue for some time. We might see this just drift up like this till we might very well possibly see a stronger move lower. Until we get above here and start building a base back in this triangle, to me, all of this right now, super bearish for the banks. Here is gold. Then we're going to talk about silver. And then we're going to close this off for the day. I've already talked a lot, all right? And what do we got going on here? Well, first off, before I get into it, I always forget to remind people, if you can, like the video if you're still watching. It's greatly appreciated. Share with somebody, leave a comment, engage with the content. It helps my channel grow. My channel has been growing very rapidly thanks to everybody here. I do these videos, like I said, Monday through Friday, 5 days a week. It's a lot of work to keep, to edit, to publish, to do this, all this stuff. So those little tiny things really go a long way. So thank you for everybody that has been supporting the channel. Here's gold. We broke down through this descending triangle, closed below the 50 period. When we got below that, right, it was a big aggressive move. I was buying some gold here. I told you guys this. I bought an ounce here at the bottom, bought an ounce down here. Now we're kind of seeing this technical retest. That's, to me, is technically fine, right? So we broke down, now we're getting a retest. What concerns me as a bull, quote unquote, right? But it doesn't because I want the price to go lower. But what concerns me is that the retest typically leads, if it holds there, once support is broken, it then becomes resistance. So this is resistance. We get a retest and then we get a leg lower. So then we might head into this 1800 to 1825. How can this change? Well, if the dollar starts getting pressure to the downside, we'll see gold most likely move back up into this trading range, and then it'll just be more of a trading range and not so much an ascending triangle or descending triangle, and we'll remap it out. But we got to see gold recapture this blue horizontal line, build a base to give us more confidence that, hey, you know, this was no big thing, this big drop off here. That was just an opportunity to buy more. This trend line still technically holds up. Okay, if we draw this trend line out longer down to here, we're coming back up to retest it right around this area. So if we get a break above this higher trend line, and I'll remap this out eventually here soon, that could be very, very good for the bulls to start seeing this market move higher. Yeah, we still got to give above the 50 period, and that'll even be, you know, more momentum to the upside. But this one right here looks like just a technical retest. This, to me, is just wait and see what happens, not just enter in right now. You know, a breakout of this higher trend line on, you know, good volume would say, all right, we're seeing this thing move up higher. I would be in for another trade right there. If we see the back test down, you know, if it gets rejected here, then I'm looking at these levels down here to buy some more gold. Oh my gosh, my voice, just so you know, it feels like it's just going right now. It's not good. Here's silver, symmetrical triangle, broke down. We were tracing this, landed on this trend line and this nice hammer candle. And what did we say? We said this could be a dead cat bounce. We bounced. Now we're seeing weakness. This is bearish engulfing these two candles here. It's still holding at this trend line, but man, if we close below this trend line, gold or silver is heading lower. It would make sense to see this head lower. If we break through this trend line, showing this weakness, this is just a dead cat bounce to potentially the 200 period moving average. All right, we'll keep an eye on it as time progresses, but yeah, $19 right here, that would make sense to me. I don't know if we'll go as low as the March bottom, $11, but you can I'll make the bet here. If we get down to 14 all the way to probably around this range right here, 16, and I'll consider the 200 period moving average as well, but I'll be loading up more on silver if it gets a little bit lower. The RSI is moving somewhat into oversold territory. It's not quite there yet. Last time it went to oversold territory was here in March, and that's when I was making videos saying this is the best investment opportunity of 2020. Don't miss it. I got in down here and boom, rode it all the way up. I'm still in it. You know, I'm in it for the long term, so it doesn't really matter. I did capture profits on paper asset trades. So the SLV, I did call options. Back here, I did call options for $25. Take a guess at how that played out for me, right? Played out pretty well. All right, everybody, that's all I have for you on today's market brief. I hope I gave you some more insight into the things that I'm studying, the things that I'm looking at, the reasons why, you know, I think the way I think. If you haven't done so already, make sure to like, subscribe. It's greatly appreciated. Have a good day. I'll be back tomorrow. See you later.